The black swan, as we consider the COVID-19 pandemic, brought global economy to a standstill. The evergreen blocking the Panama Canal caused for the global supply chains a massive heart attack. And on top of that, we got faced with a war in Europe. Now, all of this provoking severely disrupted supply chains, a severe increase in energy prices to a level that we've never seen before, and of course, inflation that we haven't witnessed in decades. Good morning, my name is Geert Stine. I'm the National Leader Turnaround Restructuring and Value Creation Services at Deloitte. I'm your host for today. And I wish you a warm welcome in our Navigating Stress or De-stress under uncertain and volatile market conditions. Now, during this webinar, I would like to briefly touch on the current market conditions, unveil a little bit the results of our survey. Of course, what are some measures that companies can do to face those headwinds that we're currently experiencing? I would like to also invite some other perspectives because I've invited a number of my colleagues for a panel discussion. And at the end, I'm happy to invite you to send in your questions and we'll be happy to answer all of them. Now, the different topics that I mentioned in the beginning, or the disruptive market dynamics, they have affected actually all economic parameters, and not just for the few years that we've passed, but also we are expected to face some headwinds there in the coming years. If you look, for instance, at GDP growth, well, it spiked post-COVID because companies were gearing up, but are expected to return to really some moderate levels. If you look at inflation rates, well, hyperinflation is now expected to be replaced by inflation rates that we haven't seen in decades before. And even if you look at the current account, the Belgian current account, it's only expected to be positive as of 2027. Now, if we take a closer look at the number of bankruptcies in Belgium, then you see that the governmental support systems, or the governmental support programs, during COVID-19, they really didn't miss their target. The level of bankruptcies more or less halved during that period, so 2021. But then on the back of COVID, so post-COVID, we've seen that they've been rising sharply and even enhanced to the level that it's double during COVID and again at the levels pre-COVID. Now, if we look at more than 10,000 companies in Belgium, and this is a Belgian perspective, what do we see in terms of what we call perhaps good performers, being companies that have enlisted a growth a growth both in turnover but also in EBITDA. If we consider poor performance, like there is a decrease in turnover but also a decrease in EBITDA year on year, then we see in 2020, for instance, 1 out of 3 we can consider as good or strong performers there, which was higher than years before. Now in 21, of course, there was a strong recovery post-COVID-19, with more than half of the companies, so 53% being among the good performers, but still 15% poor performers, even with companies gearing up at that moment. In 22, the economic trends, we mentioned them, geopolitical instability due to the Russian-Ukrainian war, inflation, severely increasing interest rate. They have increased the share of companies with turnover growth due to inflated prices, as on the back of inflation. But we still see that there is an EBITDA decline due to the lack of the ability to fully reflect those increased raw material prices and energy prices, so the inflation, into their sales prices. Now for 2023 and the years beyond, what is expected or forecasted is that we think that still high energy prices, a tighter monetary policy and low consumer confidence will continue to weigh on companies' turnover and EBITDA. I usually don't like slides where there is a lot on it. This is just a few examples because we've been looking at the Belgian market. Belgium is an isolated case. It is something that we know throughout the world. And whether you look at Economia or you look at the ECB or you look at the Financial Times, it is a global situation where companies feel that they're severely stressed at the moment and expect to have some headwinds in the coming years. Now, we did a short survey, and thank you all for filling out that survey, and I would like to show some results of that survey. We built our survey around 2 major questions where we said, okay, looking at today's market dynamics, what are factors that most negatively impact your company's performance? On the one hand. On the other hand, looking at today's market dynamics, What factors are hard to respond to? What do you consider as difficult to factor into your business decisions? It was clear that there's a top two, which is very prominent, being, of course, on the one hand side, the increased energy prices. So we've seen crude oil prices are commonly used as a benchmark, of course, for energy prices. Well, they have risen sharply to because of different events, and they are expected to remain high over the coming years. While increased raw materials was the second, or was number two in the top two. The war affects, of course, the global economy via higher commodity prices and then supply chain disruptions, and raw material prices are also considered to remain above pre-war levels. Now, what in the survey was clear is what is considered as hard to factor into business decisions is, on the one hand, the accelerated technological changes and how to cope with the different changes. Of course, the hike in the interest rates, and then also what will be the impact on my business, on my customers, on my supply chain in terms of the geopolitical situation. We had different companies from different industries, the biggest from financial services in our survey, and we were also able to have both large companies and SME companies to take part of our survey. Like I said, the number two reasons that are impacting most negatively the business are raw material prices and energy prices. Like I said, a clear top two with 16 and 14%. But what was interesting is that there were also some other factors that you mentioned. For instance, the destocking from previously disrupted global supply chains, and then creating like a bullwhip effect on the current demand. New legislation, for instance, the enforcing the use of recyclers. What does it mean on my business, and how can I still keep up to date with new legislation? And also the increasing administrative burden, something that we know in Belgium is something that is popped up for many years here. Now, if we take a look, like I said, increased energy prices, raw material prices, we see that, for instance, here, that businesses are expected to face the impact of continued high prices in 2023 and 2024, due to, of course, geopolitical situation, but also let's not forget OPEC oil production cuts and China's zero or reverse zero COVID policy. It is expected, prices are expected to decrease somewhat in 22, 23, 24, but not to the level that we knew pre-war in 2020, for instance, in 2019. But if you look at commodity pricing then, or I would say non-oil commodities, there it's even expected that raw material prices will decrease less than 10% even, and they still remain more than 30% above levels that we've known pre-war. Now, there is also a clear correlation, of course, to what energy prices do, especially, like I said, crude oil, but also raw material prices, because a lot of raw materials, they contain some element of crude oil. And we can see it in the graph here that they are expected to evolve in the same way over the coming years. Factors that in the survey was clear that are more difficult to respond to, like I said, were the interest rate hikes, geopolitical instability, and technological changes, and which are actually very important aspects of that. For instance, if we also take a look to a global CFO that Deloitte did, so on a global scale with all CFOs, we see those three things coming as well. But we see the policies and regulations, we see geopolitics instability, interest rates and their impact of it, and also inflation. So Belgium is not an isolated event, but it fits very well in what we see on a global scale. Now, technological changes were considered as one of the topics where the survey said, okay, this is more hard for us to factor in our business. And it's also something that is not something that you cannot consider. If you look at R&D investments and the growth rates in 2021 and 2022, in the EU, there is still a growth of 9% during that period. The US is, of course, massively investing in R&D with 16%. And we see with the US remaining on a very high level and increasing, while in Europe, there was over the period 2018 to 2022 a slight decrease, but China is picking up and is coming in 2022 to the level that we are in 2022. Now the question is then, all those technological changes, what are then the different investments that are made? I don't think that it will be a big surprise, but of course cybersecurity is the number one. Remember the ransomware attacks that we've seen picking up over recent years. Everything related to AI and machine learning, of course the cloud services, and then data analytics, they fill up the top four there. Now, of course, the question is, if you're facing headwinds, then how can you respond to those challenges? Well, usually, like I said, I'm from turnaround, restructuring, and value creation services. We work what I call the holy triangle between finance, strategy, and operations. And usually, they are interlinked and intertwined. You can also consider it as we look at things from a human capital perspective. We look at the customer view in it and the customer journey, the supply chain, and then, of course, from a financial perspective. For this seminar, we will more or less, based also on the results of the survey, have a closer look at what we consider stuttering profitability and, of course, tightened liquidity. Now, from a tightened liquidity perspective, like I said, we operate within the holy triangle of finance, strategy, and operations. From a strategic perspective, of course, what is the cash burning portfolio review? Looking at your portfolio, looking at your products, looking at even your channels that you're using, your different customers and the regions where you're operating. What is the profitability there? What is the interlink between the different options there? And of course, also, what does it mean for my tightened liquidity? And do I have some cash traps there? An options analysis is still taking into account, okay, there is a corporate strategy. We've made some choices because strategy is making choices to doing what you're going to do, but also what you're not going to do. Well, do we still have the options that we expected a few years ago or a year ago, and to have a refresh there and see what it means from a strategic perspective? Talking about a carve-out, I mean, M&A is a lot in the press and is a hot topic. From another perspective, of course, sometimes it could be a solution from a strategic perspective to make a decision like, okay, there is a certain type of business which is not core or which is underperforming compared to other businesses. Well, should we consider a carve-out? More from an operations perspective, making the analysis, is it make or buy? Of doing the analysis, are we going for just in time or is it just in case inventory? What are the benefits of Lean Six Sigma in terms of asset management for my company? And all of this, when we're talking about liquidity, we know the cash is king, adagio. Finance, well, cash flow planning, 13 weeks rolling forward cash flows, doing it on a very granular level, not just looking at accounts receivable, accounts payable, and inventories, but also, for instance, on production units, on sales units, etc. Is my debt and capital structure still in the right way as it should be? And is it still serviceable for me over the longer term? In terms of working capital, what can we do to increase our working capital? Because our working capital is actually very closely and has a very large impact on our tightened, if it's a tightened liquidity, of course, and also profitability ties in to the cash aspect. From a stuttering profitability perspective, usually it's not just from a cost perspective. Of course, changes in cost structures, whether it is via a strategic cost transformation, you know what the impact is. Strategic choices in terms of new regions that you're going to enter, new products that you're going to bring in the market are still an estimate of what's going on. So cost reduction is a certain thing, while there it's more a strategic choice. On the other hand, reviewing your pricing policy, making sure that your discount policy is still in line. What is going, or is the rule or a policy and procedure within the firm, but also is it still competitive towards what my competitors are doing? Of course, from an operation perspective, my product portfolio management, what does the bill of material of my products look like? How are they composed? Can we use other raw materials? Remember the increasing raw material prices. Do we have a supply chain that is still, from a strategic perspective and from an operational perspective, in line with what our customers need? Do we have like more a centralized structured supply chain? Do we go for delocalization? Looking at delocalization of a company in itself, like we have different sites, but what is the optimal site to have? Is it all in Belgium? Is it in Europe? Or do we go for a more decentralized versus centralized operations there? And from a finance perspective, even in terms of profitability, if you look at your debt levels, are you still able to service them? But also, what is the costing of my debt structure? How does my debt stack look like? And I can change it, which has an impact on my profitability as well. What do I do with inflation? Can I recharge like the full price of my inflation to my customers? Do I need to go for an operational improvement so that we can do it in a leaner way? Do I take a factor in also commodity hedging, interest rate hedging, etc.? Now, this all as an introduction to the next step also. So I would like to take you with me to a few of my colleagues so they can also give their perspective on what they see in the market and also how we can face those challenges. So please join me. Thank you. Good morning, colleagues. I would like to briefly introduce the colleagues I have invited here with me at the table. So on my left-hand side, I have Martin Proctor, who is a director in our AI&D business and a specialist in terms of energy management. I have Kirsten Delnoz, who's a director in our supply chain and operations practice. And I have Sebastian Preckler, who is our leading partner for all debt and capital advisory services. So welcome, guys. Like I said, a panel discussion, so I have prepared a few questions. So if you could share your opinion on that, I would like to start with you, Sebastian. In terms of interest rates, how do you assess the impact of the higher and increasing interest rates that are now filtering through the economy and for sure having an impact on companies that are perhaps underperforming, stressed, and definitely distressed?
Okay, thanks, Geert, and thanks for having us. And very good question. I think the impact is huge. That's the clear answer to that. And not surprisingly, I think we're coming off a period where the economy was on steroids, fueled by cheap funding, and still we're not seeing the full impact taking place yet. Our companies are still benefiting from locked-in interest rates, partially because of fixed rates or some of the interest rate hedges they took, and now we're facing for new liquidity or renewed hedge positions on the interest rates to face the full impact of the high interest rates. And companies, they see or saw their interest cost doubling, tripling, or even quadrupling. I think we're talking today of a benchmark interest rate, a Euribor of 3.5% compared to negative rates or zero. And the increase is not over yet. I think tomorrow another big meeting at the ECB. I don't have a crystal ball, but they talk about a quarter increase again and another quarter increase in September. So I think the pain is not yet over. And as I said, I think we will see the impact of that filtering through for the next coming 2 years. And of course, that impacts corporates in stress. I think if your profitability is hit, your liquidity is hit, and then you're faced with such an increase in the cost of financing, I think, going towards additional financing to solve your problems might be difficult. So turning to your cost base, I think very important, and also making decisions on your investments will be key.
Absolutely. Thank you for that, Sebastian. Kirsten, if I can go to you now. Now, how can businesses get the best of both worlds? I would say the best of world by limiting working capital demands of a safety-first supply chain, as we call it, while avoiding the unnecessary risk of being overly lean.
Mm-hmm. Yeah, that indeed requires a two-pronged approach. So on one hand, we need to look at dealing with changing demand patterns, dealing with mounting pressure on sustainability requirements for supply chain, the future of work, flexible work economics. But on the other hand, you also have those macroeconomical disruptors, the interest rates, the raw material prices, and that seemingly paradoxical requirements really put a big pressure on supply chain. So how can you deal with that? So first of all, companies are really re-looking into their supply chain structure and their key parameters that drive their supply chain. On one hand, where to perform the work. So the make versus buy decisions. What to do internally, what to outsource, but also where to put, for example, your semi-finished production. Not just looking at the country costs, but really looking at the total cost of ownership to decide what to nearshore, what to offshore. Secondly, it will also be important to have an integrated view on inventory and demand. That can be done through, on one hand, digitalization, digital tools, but also, for example, self-service analytics, a combination of the two. Aside from that, you will also need some solid S&OP practice, solid sales and operation planning. And if you combine these two, you have the opportunity to have a much clearer, more robust forecast. And that results in better opportunities to maximize or optimize your safety stocks. And if you can optimize your safety stocks, you can also optimize your working capital. And then maybe sharing a third point, which is more related to risk and mitigation decision frameworks. So how to address different risks across the supply chain, risks resulting from that macroeconomical changes, but also risks resulting from disruptions. And there, what we see successful companies doing is really going to a next level of granularity, addressing that on individual product levels, but also involving input of different functions, of procurement, of core supply chain planning, and of commercial as well. And that way you can take those elements together to really put focus on these mitigation actions that, for example, ensure availability of raw materials for those goods that are more prone to risks and that also have a positive and solid contribution to your margin.
All right, thank you. And which is also, again, a nice example where sales and operations go hand in hand, of course.
Absolutely.
Now, Martin, for you as an energy specialist, I would say, I've talked about, or I've touched about in the introduction, the impact of the energy prices, of course, from a cost perspective and on the profitability. But how can energy consumption be viewed through a profitability and sustainability lens? Can we say that both are mutually exclusive, or do they go hand in hand more?
Well, thanks, Keir. That's a really nice question. So, energy prices have been something which have been stable for a very long time. It was just a given. The electricity and gas prices didn't change that much on the for European companies. That all changed when Russia invaded Ukraine. We saw the massive spike in electricity and gas prices this summer. Now, the result of that is that companies started looking at, well, how much energy am I actually using? How much electricity am I using in my process? How much gas am I burning in my production, etc. And we suddenly saw that because we had always taken it as a given, the inefficiencies had built up. So we're using old machinery which perhaps wasn't as efficient, using processes which perhaps needed to be improved. And there was significant savings which could be made. I mean, we saw companies where there were 15 to almost 30% energy savings which could be made in the key processes. But whenever you go and burn gas, you create about 200 grams of CO2 per kilowatt hour. If you have natural gas escaping, natural gas is methane, so that's 4 times more impactful. So let's say it's about 800 grams carbon equivalent, which you've got. But then your electricity also, which you consume. Now in Europe, the average electricity carbon production is about 200 grams per kilowatt hour. But that hides a big variation. So you've got France, for example, is about 50 grams per kilowatt hour because they use a lot of nuclear power. But if you go somewhere like Poland, it's around 800 grams per kilowatt hour because of the huge amount of coal. If you go outside of Europe, you can easily be topping 1,000 grams per kilowatt hour if they're going with all the worst forms of coal for fuel, for energy production. So when we look at our energy costs, and yes, Brent crude is the crude is remaining high, gas prices and electricity prices have come down from their peak somewhat. But when you cut the energy prices, when you cut the energy consumption, you automatically cut not just the amount which you're spending on energy and therefore improving your profitability, but you also directly cut the Scope 1 and Scope 2 emissions of your company, something which is required by us all to go and meet the new requirements to be carbon neutral by 2050 as a continent. So I would say that these two are not opposed to each other. In fact, they are completely mutually supportive. One enables the other in both directions. So yes, they are two aspects which fit perfectly.
Yeah, and like it sounds, there is still a long way to go in not just your energy bill that you can decrease, but taking a look at the global process, like what is feeding my energy bill and to improving profitability there.
Absolutely.
All right. Perhaps going back to you, Kirsten, can you share some best practices to manage peaks in raw material prices and cost inflation?
Interesting question. So, well, it starts with having a very consistent raw material breakdown and cost breakdown. So both the bills of materials, but also understanding really that costs on different levels. On one hand, on your stock keeping unit level, but also on your product and your category level. And that can help you utilizing supply chain information to make much more informed decisions along your entire value chain. For example, which products to discontinue, which products to put more focus on through your sales channels, those where you know that they will not be impacted that much in the medium term through raw material price evolutions, for example. You could also consider tracking of commodity futures. Tracking of commodity futures can help you to make more informed decisions on sourcing, to also have better planning, and to also have, again, that better link with commercials. And some companies even go a step further and really take these parameters into account in their product development. For example, looking into product specifics that have alternative ways, alternative usage of raw materials to avoid that more costly, price-sensitive raw materials in their value chain. And then last but not least, I would also advise to take a look at the interplay between supply chain and tax. For example, if you look at your customs duties, it's typically expressed as a percentage of the value of your goods. So there it's important to have the right classification, but also the right valorization of your products to avoid that you overpay taxes there.
All right, thanks. Sebastiaan, if you look at the current volatile times, I touched upon it, geopoliticals, the macroeconomic situation, if we think at the banks, SVB Bank in the US, and then a bit as a fallout, also Credit Suisse in Switzerland, it has led to debt markets that are not always as accessible and perhaps some would say less liquid. How do you see companies in distress or those anticipating to get some level of stress navigating this? It's a complex financing question for them.
No, indeed. I think it's just a reality which I think all corporates, but definitely those in stress or de-stress or pre-stress, will need to address and be aware of. I think it started already when the interest rate environment started changing. Then the energy crisis filtering through, and definitely with the fallout from some of the banks. I think we saw definitely in the more risky space of the debt markets, the leveraged finance market and the high yield market, that we saw the markets shutting down, slowing down, and not being accessible for everyone, and definitely the prices went up significantly due to the interest rate environment. So that of course impacts significantly, of course, in a stress environment, and on how to anticipate and navigate that. I think people, corporates, whether in distress, going concern, or anticipating stress, are in need of anticipating their debt and addressing their debt maturity walls well in time, not just 12 months ahead when long-term liabilities fall short-term, but definitely 24 or 36 months in advance. So that is what we see people doing, looking to refinance early, to extend their maturity levels, and also if they think there is stress coming, to make sure that on the liquidity side you tap the markets in time to address these markets. Maybe bring it also more to a local level, because those were the broader markets. I think in the local market where you bank with the 4 Belgian banks, for example, they're open for business, but them again, they have their risk mindset on. So addressing them, informing them well, prepare in time your sensitivity cases on your business plan, your cash flow planning, are key to have a successful negotiation with your banks to address your maturity walls and navigate certain headwinds you might contemplate.
Yeah, and absolutely, I agree. Being well prepared, then they're definitely open for business. Now, I asked you guys a lot of questions. Perhaps I would like to open up our Q&A as well, and we have a Menti QR code, so you can scan it with your phone. Send us your question, and I will be happy to answer all of your questions that come in now. And I already see a first question coming in. what is exactly the right timing to face underperformance, stress, or distress? If it's okay for you, I will take this question. It is a question I often get, by the way, and I would say as early as possible. As soon as you can address whether it is underperforming, the options that you have to mitigate the situation, to adapt to the situation, are much bigger. There are much more, and perhaps will have that severe impact as when you come into a situation where you're actually distressed, you're severely cash distressed, because distress is what I always say, there's a lack of oxygen and a lack of time at that moment for a company. But addressing that as early on and head on is the best way of moving forward. I always use a bit of an analogy where I say, okay, when you have a garden and you have a rose garden, it is good practice to go through your garden once a year and see what are the roses that perhaps aren't blooming anymore or taking food from the other ones, and just cut them away and make sure that you have a healthy garden the next year. All right. We also have a second question coming in, and that is, with rising interest rates, what is your opinion on What is your opinion on the evolution in deal volume? Perhaps, Sebastian, that's also a question for you.
Yeah, I think important evolution, of course. Definitely the macroeconomic and the interest rate environment has impacted significantly the M&A deal making, a slowdown thereof, and definitely the execution risk of M&A deal making, whether that's in a distressed M&A activity or a more growth strategy. It is more difficult to navigate. Price expectations, valuation expectations, for sure, is a mismatch often, and where deals break down due to changing environment, trading updates not going the right way, or reading what are the normalized levels, because we moved through COVID into an inflationary environment. Where, of course, working capital and supply chains were hit severely. So all these parameters make deal making very, very complex. And that's where we see, definitely on the private equity side, primary deals slow down significantly the first half of the year. And we noticed that private equity platform focused a lot on bolt-on acquisitions, creating value within their own perimeter of activities, but also optimizing their activity portfolios. So carve-outs also is high on the topic in order to create value for your company and manage the M&A deal-making risk yourself.
Yeah. All right. Thanks for that. I don't see any other questions coming in. I guess it was clear what we presented so far. So if there aren't any more questions, then I would like to thank you guys. So thank you, Martin, Kirsten, and Sebastian. I also thank you, all the different attendants that were present today. If you have any other questions or remarks, or you want to touch base on any of the topics, please don't hesitate to reach out to me. And then again, thank you, and I wish you all a beautiful day. Bye-bye.